Safety is a primary concern in any financial strategy. Taking a calculated, understood, and informed risk is one thing, but exposing yourself to unnecessary risks, which could easily be avoided, is quite another. When it comes to money that you're counting on, and especially money you have worked so diligently to save and expect to have access to during your retirement, you better be sure it's stored in a safe place. But which places are safe? Massive amounts of advertising have conditioned us to store our money in banks, both for short and long-term storage. But are banks the safest place to hold your money? Rather than answer that question directly, let's compare and contrast holding your money in a bank versus depositing it with an insurance company via a permanent dividend-paying whole life insurance policy, and then you can decide for yourself. Let's start by considering what the overall purpose of a bank or a life insurance company is. Their sole reason for existence is to make money. But who are they making money for? A bank's primary responsibility is to make money for their stockholders, so they can get a return on their investment. After all, that's why the bank was created in the first place, to benefit the stockholders. Stock-owned life insurance companies, like AIG, are also responsible for making money for their stockholders. Just like banks, they must keep their stockholders happy. A mutually owned life insurance company, on the other hand, is responsible for making money and providing a return for their policyholders, which would be you. There are no stockholders in a mutual life insurance company to satisfy. Executives at banks and stock-owned insurance companies are responsible to their stockholder, which means they have incentive to take additional risks. They are, therefore, vulnerable to the pressures of maximizing short-term, quarterly profits in order to appease stockholders. The executives at mutually owned life insurance companies, however, have a totally different mindset. They answer to their shareholders, who are the policyholders. Because a mutual insurance company's focus is to guarantee maximum benefits to their policyholders, they are not pressured to take risks to maximize short-term profits of any stockholder. This allows management to always have in mind the long-term safety, security, and return for you, the policy owner and shareholder. An article in Forbes in December of 2008 clearly depicted this stark contrast between working for shareholders versus working for policyholders by stating, with their survival on the line, publicly traded insurers are scrambling for cash by cutting dividends and issuing new shares, diluting existing investors, begging regulators for a relaxation of capital requirements, and lobbying Washington for a cut of the $700 billion Wall Street bailout. It goes on to say, their mutually owned rivals haven't asked for a dime. Their statutory surpluses, the regulatory counterpart to book value, have held steady or even increased. Some are announcing plans to pay out near-record dividends to policyholders. This might explain why certain mutually owned life insurance companies have been able to pay out dividends every single year for over 100 years, even during the Great Depression. Now, let's take a look at what would happen if you had money deposited with a bank or mutually owned life insurance company that went under. Assuming the bank is an FDIC-insured bank and that your money is in a checking and savings account, money market account, or a certificate of deposit, your deposits are insured by the full faith and credit of the United States government up to a specified amount. Since 1980, that amount has been $100,000 per depositor per bank, but was temporarily increased to $250,000 through December of 2009. Under the Federal Deposit Insurance Reform Act of 2005, individual retirement accounts inside banks are also insured to $250,000. You may be surprised to learn that the balance in the FDIC's Deposit Insurance Fund, which is the account that insures your deposits, contains approximately just 1.25% of all the deposits it insures. Unlike banks that are regulated at the federal level, insurance companies are tightly monitored, audited, and regulated by state insurance departments who require them to maintain adequate reserves on hand to meet their obligations. In most states, if an insurance company begins to have financial difficulties, the insurance commissioner in the company's home state first steps in and takes control of the company to try to help it regain its financial footing. If unsuccessful, the company is turned over to the State Insurance Guarantee Association. The Guarantee Association will either transfer the policies to financially sound insurance companies, or they themselves will provide continuing coverage and benefits to the policyholders. Similar to the FDIC, state guarantee associations also provide benefits up to a certain limit. Although it varies from state to state, most states set basic limits of $300,000 in life insurance death benefits and $100,000 in cash surrender or withdrawal value for life insurance. So, while there are safety nets for your money with both banks and mutually owned life insurance companies, it seems important and telling to reiterate the article in Forbes that states that publicly traded insurers are scrambling for cash by cutting dividends and lobbying Washington for a cut of the $700 billion Wall Street bailout, while their mutually owned rivals haven't asked for a dime. And some are announcing plans to pay out near-record dividends to policyholders. Those facts speak for themselves. So, congratulations once again on your decision to become your own banker. You will soon be in a position to stop supporting the employees and shareholders of other banks and finance companies through all of the interest you are paying them, and instead use that money to support you and your family. You'll soon discover that becoming your own banker will prove to be one of the wisest decisions of your lifetime.